Hey there, everybody. Thomas Wood with Basecamp Trading. It is Monday, May 7th, and we're going to take a look here at bonds, and more specifically, one of the things that's going on with bonds here, which is just kind of compression. And one thing that happened today in the trading room, I did not take any trades today because we had really choppy markets, no open positions, no trades placed, just kind of watched the markets all morning. But one of the reasons I was looking at that is because, for example, with bonds, we were just in a choppy sideways phase here, except for the one period where that brief period where we broke above that 20-30 seconds double top, spiked high, and then reversed and pulled back down to compression again. So what you want to watch for when you see a market doing this, it's just moving sideways, you want to look at your lowest pivots for support and your highest pivots for resistance. And you're not going to get any big moves until it breaks out of that compression. So for example, if we're going to get a big move to the downside here in bonds, it would need to first break through 11-30 seconds support, and then secondly break through 43 and 5-30 seconds. Now the reason I went with 11-30 seconds as opposed to the 12-30 seconds level there is because even though 12-30 seconds have been tested twice to the tick, there's that pivot low that's just one tick lower that you do not want to ignore. So when you have that, you have well-defined support where it's tested it twice, but then a tick or two lower, there's another support level, another pivot low. It's always better to wait for that secondary pivot low to be broken. So in order for us to trade this bearish, we'd have to wait for it to break below 11-30 seconds, and then we could be looking to place trades short. And if you do this, and you see markets that are in chop, or see where they're just bouncing off of pivots, they have well-defined support, and you're just kind of hanging out just above that support, you can avoid getting chopped up in markets because you won't be placing any trades until it actually breaks out. And that will, in turn, again, help keep you out of sideways markets where the market doesn't really move. So keep an eye on that again. Watch for your support and resistance levels. If you see a market just kind of hovering above a well-defined support level, don't mess with it until it breaks through it, and then you can look to place trades, because you don't want to be placing trades in a market that's moving completely sideways like this unless you're trading spreads. So that's it for today. I'll see you in the trading room bright and early tomorrow morning, and until next time, happy trading, everybody.